Now you can see this fair value gap here. Would you take that? No. Why? Because we've already moved a lot and we've already tapped into sell side. So what could happen at the open, we could start to sell off a little bit, get everybody thinking, okay, it's been going down, it's going to keep going down, so they'll dogpile in going short, and then they'll rip it up above this volume imbalance. This here is the only exposed area I see in price, with the exception of this one. Why? There's no overlap between the candle before this one with this candle and this candle between their respective highs and lows, meaning this here and here, if you take that there. So that is a SIBI. It is a fair value gap by classification, but specifically it is a sell side imbalance, buy side inefficiency. So within this run from here to here, that is above equilibrium. I'm not stating that this is what's going to happen, folks. Be mindful of that. And then some of you are like, okay, he's telling us it's a buy. I'm not saying that at all. I'm answering questions you're probably seeing. This fair value gap, what would you do with it? I would do nothing with it. I would watch. Why? Why are we watching price right now? Because it's already fulfilled several things on dollar, and it's already fulfilled a run on liquidity here ahead of 930. If this would have been trading up here still, I'd say, okay, I'm looking for a short and I'm going to target that low. But because we already broke down, the model that I taught last year has already delivered. So since it's already delivered what I would expect reasonably, so you have to be careful. So anything here that we get from this fair value gap I mentioned, we could take out that low, entice new sellers at the open, and then this is electronic trading hours. If you go here to regular trading hours, right now the price is 41.13 and a quarter. Okay, we go to regular trading hours. Chart looks different, doesn't it? So we're down here in electronic trading, and we have a gap from yesterday's close to here. So now think about that. We have already tapped into sell side here. Don't worry, I'll go back into that chart in a second. We've already traded down here. We hit it. Yes, we do have a fair value gap here. But just because it's a fair value gap doesn't mean it's a tradable entry point. It's something that we watch, just like this volume imbalance here. Okay, because we're down here at 41.13 and a half in electronic trading, the markets are going to see the market as a gap lower, and street money sees, oh, it's weak. Let me get short. Let me sell my stocks. And we're about 30 seconds away from the opening. So any movement lower, they're going to chase that. When we have a significant gap between where the markets view it from regular trading hours, it's more likely that they'll want to trade back up into that range versus I would not want to chase it lower here. So not every fair value gap is an entry. Not every imbalance is a reason to get into the trade. All right, market's open. Now I'd like to see it. I want to see it take out that low, to be honest with you first. I don't want to see it run from here. I want to see it take out that low. Man, I hope my audio's been working. Look at that reaction off the fair value gap there. That was nice. But you said, I didn't say anything except for just study it. I don't want to do anything with it yet. Now we've taken out the low. If we can rally, okay? If we can rally. Now I don't know for certain we're going to do it yet because it's only a couple minutes now into the new opening. But if we rally above it and find some support here, that's what I'm watching and observing to see if we can do that and then run up into this area here. Otherwise, we could very well just keep on melting lower. And then later in the morning, going into the afternoon, try to do something I was just outlining with that gap from yesterday's trading. Okay, now if we go back to regular trading hours, this is what everybody's seeing. The market was here and we gapped down. Oh my goodness, the market's going lower. So street money's doing what? Selling, selling, selling. Be mindful of this. If we do continuously drop, 41.0650 is something, in my mind, significant because it's consequent encouragement of that wick. Let me see if I can make a visual aid here. So theoretically, what I'm saying is from the close of yesterday to the open of today, this range is likely to be traded back up into. So all of this here. And where does it take us up into? That fair value gap, which is why I mentioned it earlier. So all of this now has been explained, why it's important to me, why I'm watching it, why it's even worth mentioning. So on the downside, we had that consequent encouragement on that wick. I would have liked to see that hit that first, but if we rip from here, that's fine. And before you can get to the point where you can get in and take trades and trust what the logic is that you're trying to trade on, you have to do this part, folks. And it feels like it's a waste of time. It feels like it's monotonous. It's unproductive when it's extremely productive. Sitting here watching these candles form around specific times of the day, the logic behind it, why it should do certain things, why it shouldn't do certain other things, it's crucial. And you won't be influenced by anybody, not that you should be on social media anyway, but listening to other people. If you have no business, trying to find your own model or trying to develop your own approach to doing it, or you don't have the discipline to do it, you've known that enough to you would rather follow someone else that knows what they're doing, then there's nothing wrong with that. But if you're trying to learn how to do this, my opinion is even if someone's successful and you're following them, the only thing you're developing is codependence. And I don't like that in people. Like, I think independence is a much stronger trait than, depending upon someone else to show you their cards. But there is a market for it. There's a student base out there that's better suited for that because they have no interest in learning how to trade because they know their own limitations. So think about what has transpired here from 7 o'clock. Okay, from here down into the sell side. So it delivered a beautiful low resistance liquidity run. It was in agreement with the dollar index going higher. We had support of like the euro wanting to go lower, gold wanting to go lower. So everything with a risk off scenario delivered price, as we see here. The better, and this is for your journal, the better morning sessions are if we open up with this framework as I've outlined. If it hadn't done the drop, like say for instance it was trading like here at 9:30 and we hadn't taken out that low yet, that is a real obvious easy opening session trade where that's where I would be doing it. But notice what has already happened at 9:30 right here on this candle. It had already delivered into the sell side. So in my mind, my experience tells me just sit still. It's already done something. And because it's opening at 9:30, there's initial volatility, there's uncertainty. We don't know if it's going to run up into that red area here. I could be completely wrong. It could just go right on through that 41.0650 level and dollars scream higher. That's the uncertainty that's associated with this type of market structure at the time of the 9:30 opening after the delivery of the model that I taught you last year. Everything has already transpired, so we have to sit and wait, demand more information. That is never a bad thing. It's never a bad thing because trades always repeat themselves. There's more setups that's going to work repeating in the future that you're going to keep yourself from being able to be a participant of by rushing in low probability uncertain times because you're here in front of the charts, so therefore you must take a trade. That's asinine. That's gambling. Watch that 41.0650 level. So here you go. You have an example of me outlining a trade that I would not take, which is trading in that fair value gap, but it offered 5 handles. You might look at that and say, that was perfect. That's cherry for me. It meets every one of my criteria. Don't let me influence you. I'm just saying because you want to hear me tell you these things. This is what I would do. This is what I wouldn't do. This is why I wouldn't want to do it. That's mentoring. Now, if we get above this fair value gap now, after this, and touch it as support, I think we could potentially run up into here. I still would have favored that 41.0650 hitting first, though. I've drank 2 bottles of water, so I have to relieve myself. I'll be back in a second. Just watch and see if we get above this gap here, if it acts as support. Watch and see if it delivers there. All right, so now we have traded up through the fair value gap. Now look to the left. What do we have here? 1, 2 down closed candles. Midpoint of that, both ranges are potentially a bullish order block. We don't know for certain it is until we displace. So I'm watching the midpoint of that level. I don't want to see price go back down below that. I would want to see it rally from here and trade up into that level here, not piercing or going below this level here. If this was a trading day, like say I wanted to take a trade, I would not use full leverage because it's going against what? What's the undertone of the marketplace? The market is likely to see what? Higher dollar if it continues. So that's what? Invitation for risk off. So while the trade might be there, it very well could deliver and go up into 41.21. I can't offer myself the potential to lose full risk. Like the industry says, it's 2%. It's too high for someone that's new. 2% is too much risk. But whatever your maximum threshold for risk would not be utilized on a trade like this. So let's, for instance, say you see me trade with like 20 contracts. I would do like 3 because it's engaging price. I'm not opening myself up to larger risk against the potential for the dollar index to rally higher, which would put pressure on a long entry in forex or in index futures like this. So there's a lot of managing and weighing out that has to be done. It's simply not just give me an order block, give me a fair value gap. You have to measure these things out. And your primary role as a trader is to preserve capital and manage risk. Because if you don't do those two things, it doesn't matter what pattern you learned. It doesn't matter what structure or approach that you use to trade with. You're going to lose. All right, so the next point of interest we want to see it go through would be the volume imbalance here. Now, I would want to see if we can do it. If it can trade through the volume imbalance, I want to see it do so with speed and no respect of it. In other words, I want to see it go through it and not come back and touch it. Now, it can go up to it, start a new candle, touch it, and then expand. That's fine. I'm not looking for a type of run up, stop short of this box, and then come back down, find support, and then go up to it. I don't want to see that. Why would I expect something like that? Why would I want that? Number one, because we have outlined this morning that the dollar index has been bullish. It can continue being bullish later in the morning here and completely pressure this from wanting to go where? Preventing it to go higher. So you're trading right now in a what? High resistance liquidity run. It doesn't matter if it goes up here. That I don't want you thinking I was right or we were right watching it. That's not what I'm not trying to build that as the argument. What I'm saying is look how hard it is for price to want to get there under these present conditions. I'm teaching you high probability trading, but I have to teach you what high resistance liquidity runs look like so that way you can avoid trading them, or at least once you get into trading, you've identified it's what it is, you can pare the risk back and not demand that it goes to your targets. Because many times in these types of conditions, I might see a potential setup. I might see a target. I've made mine available here. This is what I think is likely to occur. I'm more prone to be wrong, if you want to think about it in terms of being right or wrong. I'm more prone to be wrong and not have my trade pan out when it's under these types of conditions. Which is why I teach my students to specifically target times when the market's likely to go one direction. It's so heavy-handed. It's very hard to defend, to present both sides of the equation. So if you can look at a trade setup and you can argue it from both sides of the coin, like I could see a sell here, I could see a buy here. In my definition, that is a low probability trade. Versus it is so overwhelmingly likely to go this direction because it has all these other factors behind it. That to me is high probability. And I understand the limitations of the terminology and definition I just gave there for someone new. That doesn't do justice. But for someone that has been doing this for a little bit of time and maybe not even profitable yet, it made much more sense to that person, and maybe even more for those that are profitable. You know what your setups look like, and that's what I'm saying. But as a new student to the marketplace, you really don't know what your setup is, because you don't even know what you're doing. You're just floundering around watching these candles and trying to chase the next person that's hot. So in this instance, say I was unaware, not that that would happen, but say I was unaware that the dollar index has been trading the way it has been. Okay. Say I got myself into a trade and I discovered that I'm in a high resistance liquidity run. At this moment, I would start doing that typical, I want to see in the next 2 or 3 minutes, I want to see some favorable price action. So that means I would want to see it start to trade higher, take out the short-term high here, and at least touch the volume imbalance. So since we have the markers here on the 5-minute chart, I'm going to start dropping down in our time frames. And you can see there's really nothing in here. It's just a lot of chop. And I'm only telling you what is likely to occur, because we've already went down. We took out the low. We have a volume imbalance, and we have a fair value gap here within the gap that's established from yesterday's trading to today's opening. Okay, it's 4 minute, 3 minute. Look what's here now. Relative equal highs. They're very clean. I like the idea if it can run one more time below that low, hit that 41.0650, maybe even pierce 41.0650, and then if it rejects that, these levels here I think are much more significant. Right now, it's still a lot of uncertainty there. And again, these are the conditions you get once you see the delivery of a objective on a setup. Again, getting back to that sell side here, because it's done so before the 9:30 opening. This right here, this is exactly what makes the morning chop at the opening. This is what creates that condition. All these factors together, because it's already delivered what would be reasonable in terms of a very high probability, low resistance liquidity run signature. It just means, in plain terms, easy language, it would be the easy setup going short has already happened from over here, and it went to target. So since it's already done so before the markets open at 9:30, that means the market's going to chop around until it can establish more sentiment. Right now, in my opinion, they're trying to force the narrative that it's going to go lower. And they like to do that with presenting relative equal highs like this. So that looks like what? Oh, it stopped here, and it starts to drop down. So that means what? This is resistance, right? That's what a retail trader sees. That's what street money sees. What's resting above those highs right now? Buy side, buy stops. So ripping above that and the volume imbalance, how far can it go above that into this gap here, which now is refined with this candle here. So from this candle here and here, so we can refine it to this. It's a little bit more sensitive, because initially I had it set on the 5-minute chart. Now we're in a 3-minute chart, so it's a little bit more refined now. And so hopefully, the point is you're learning this morning how to anticipate the chop, the anticipation of when the market's going to rip higher and build bias, even under the presence of a high resistance liquidity run. We had our volume imbalance traded to here. So remember I said I want to see in the next 2 to 3 minutes it needs to get into that volume imbalance. So it's met that threshold. This down close candle here, the way I observe that is I don't want to see it go down and close below the midpoint of that. It can come down and touch it. That's fine because it's also that old fair value gap. But I want to see if it does that, it needs to rip higher and aggressively run. Now think about, and now some of you in here have tried to press the button, I'm sure, and you're flipping out right now because you're seeing all this chop and you're wondering, is this the day ICT's got it wrong? Is this the day he's going to be right? Oh my goodness. You're worrying about the outcome of your trade that you should have never entered versus having the peace of mind knowing how to read this and not have any emotional commitment to it whatsoever. The folks that are not pushing the button are actually learning today. You're learning fear and greed and buyer's remorse. But imagine if you were in a trade right now. Is it showing you a state of delivery that is very comforting? It shouldn't. It's choppy. These are market conditions when you're in them, they feel like you're being strangled and darkness is about to slip on and envelop you. You can't, it's like it's choking you. And you don't want to be in trades like that. You want to find trades that are very easy. Just once you get in them, not long after entering them, it starts moving in your favor and it starts delivering quickly and you have big ranges in your favor. That's a low resistance liquidity run signature. That's what I'm teaching you to find. But you have to see what they are not to know when they exist. This is a high resistance liquidity run. It still can deliver. It absolutely can do it. But it can do so with gray hair or a loss of hair. It's very stressful sometimes, and it feels like it's an eternity, and or it completely fail on you, and that's always a probability with any trade, really. But it's more likely to fail when you're trading in these kind of conditions. And I hope I'm communicating that effectively today. So we've taken those smooth relative equal highs out. We traded up into the volume imbalance and we're back down in here. So in my mind, watch this fair value gap now because it might want to act as resistance and tag that 41.0650 level. Tug of war today. These are days I'm so glad I'm not in it. When I was a younger man, I would insist, there's something to do right here. I just don't know what it is. Let me take a guess. Oh, regret that. All right, so now watch the 41.21 level. Looks like it's respecting a breaker. I mean, it's not the best breaker. Let me show you. We have low, lower low. So I'm watching how price reacts in there. I don't care about the wick. I'm looking at the body. It's really, really hard to read it when it's like this choppiness. And it's just really like an experience thing. And if I'm right, don't read into that as skill. It's not skill because it's not something I'm pushing a button on. But you should be feeling the trouble, the struggle, the difficulty in reading this, which is exactly when you identify it like this. Here's what you do, okay? You close your trade right as soon as you discover that you're in these types of environments. Close your trade. But ICT, I'm under. Close your trade. Close it. Because you're going to end up spending more mental capital than you're going to make in realized profit. Even if it goes to your target, you're going to spend more time worrying about this trade when there's so many other very good setups that aren't going to force you into something like this. When does the market chop at the open? When it's already delivered its move pre-market. And that's what you're seeing here. And then it becomes a 50-50. It could go up to that red box. I'm hoping that it doesn't, because I want you to see me get it wrong in these contexts, in this context, in this condition, because then it'll prove to you why I'm teaching you the way I'm teaching you. If it goes up there, you're just going to think, well, he just got it right again. I don't want that actually to occur here. I want to be wrong. I want to be wrong and say, see, this is why that condition is exactly what you should be fearful of as a trader. This is the thing you should be fearful of. Falling victim to this, insisting on it's going to go where you want it to go. Versus, okay, this is more work than it needs to be. Let me just close it and I'll come back at another time where it's cleaner. What does that mean, cleaner? When price runs very efficiently. It doesn't waste a lot of time. Retracements go to specific levels that are predetermined. We can see them. It has visibility to it. And it's easy draw. Where right now is it more likely to go to? Is it easier for it to get to 41.21 or to get to 41.0650? It's 50-50. Either one of those scenarios I could make a case for right now. And whichever one forms, the people that side with that, they will think that that was skill, and it's not. And that's what I fell victim to in the beginning when I was a 20-year-old. I was getting lucky and attributed it falsely to skill. Whereas now I'd like to believe I'm a little bit more versed. I've picked up a whole lot of wisdom through pain. So it's a big difference between me now and as a 20-year-old. But when you first start, you don't have that measuring stick, right? You just have your emotions. And as young men, we like to think, we're that caveman. We get it right. Yeah, you're Thor, the unconquerable. This wick right here, half of that essentially was traded here. And we're looking at the bodies. It's not showing a willingness to get back above that original 5-minute fair value gap, which is that green box. So let's take a look at this on a 1-minute chart. How's that make you feel? Yep. 50-50. 41.0650 or 41.21. Who's going to be right? And the beauty is neither one is a factor for you as a trader right now. You're completely at peace of mind knowing that you're not influenced by, but if it moves there, I could catch that move. There's going to be so many other moves that are cleaner, easier to deliver, to transport your entry to target much more efficiently and faster, really. Whereas this, it could go either way. This candle we're on right now just went right up to that fair value gap and touched it as resistance, as you would expect. Low, low, and low. So their sell side right below here. If they're going to go below that, they're going to run it to here and in that consequent encroachment wick at 41.0650. And as some of you are new, are thinking to yourself, man, there's no way I would know how to do this. You will. It's the same stuff repeating all the time. Everything worth doing takes a little bit more effort than the average person's willing to do. And you should commend yourself for wanting to do this, because this is one of the hardest things in the world to do. So now this is another thing I like to do, and this is how I've always taught my students as well. Say you were late to get into the charts. Okay, first sitting down, you turn your charts on, you overslept, you run to your charts, and this is what you see. What do you feel confident about? Admittedly, I'm thinking 41.0650 if I'm looking at the chart right now. But I'm not looking at the chart thinking, I got to get in that. I'm going to miss something. Look at this. Does anything in here look like anything I've taught on my YouTube channel for opportunity? No. So what are you doing? You're gambling if you enter into this. There's nothing. It's a 50-50 condition. And if you don't understand that, if you can't see that, you're going to fall victim to this type of day. I guarantee you there's YouTubers out there right now trying to insist that it's going to do one thing or another right now. And I'm not trying to be argumentative or rude to any of them. But because you're in front of other people in a live stream, you're sharing your opinion, guess what? You're going to force something. And that's why as a new student or a new trader, the worst thing you can do is put yourself out there in front of other people, because it's going to make you impulsive versus using sound logic, good risk management. And are you really following your model, or are you just doing something because you want to perform? See that volume imbalance? Right here. Now, I'm going to ask you to study this. This is a very, very poor condition to do it in. But see if that volume imbalance acts as resistance as a run to 41.0650. Nothing there. For those of you that have been very disciplined this morning, I'm proud of you, and you should be thinking to yourself, I'm glad I didn't do anything today. So the sellers that were interested in chasing markets lower today at the open haven't seen much in delivery on the downside. Since we went down below that old low at 41.13, which is the level I told you to focus on for sell side, we've had 1, 2, 3, 4 times where we ran out short-term buy side. And we dropped down and only taken out 1 with this low, 2 with that low. So it, to me, looks like we probably rounded out the morning low, and we'll likely see that 41.21 now. Down close candle, mean threshold, which is half of it, which is real close to the middle of that wick right there. Devil's advocate, say I was long, say I was foolishly trying to push something. I'd want to see it now in the next 2 candles, and we're in a 1-minute chart. Next 2 or 3 candles, I want to see it run higher and reach back up into that old buy side liquidity pool here. And if, say I was in a trade, and I realized I was potentially in a high resistance liquidity run signature and I'm having difficulty getting to target. By having this 2 to 3 minute filter, if it doesn't deliver as I'm expecting, which is this blue line right here, it needs to get above that, then I would close the trade and be done, regardless of wherever I was. That's the benefit of having that time filter. Why would I want to do that? Because I'm going to hold on to something that could potentially turn worse on me, or just stay exactly where it's at, doing nothing. So it's important to understand these conditions, because you will eventually fall victim to it. So there's a lot of times where the market looks like it's going to offer beautiful price delivery. The setups are just easy, like it's dangling candy in front of you. And then once you take it and you pay for it by entering and paying the commissions and incurring the risk, you regret it. And then you don't want to close it out because you fearfully think that as soon as I close the trade out, then it's going to run in my favor and then I'll feel stupid. Well, more times than not, you're going to regret having held on to the trade. So what are we seeing so far? Every reason to expect choppiness, uncertainty came to fruition. Let's take a look at NASDAQ. I haven't looked at that this morning. I apologize. I should have brought it up sooner. Look at the hourly chart over here. See this range we're in? Sloppy. Take a look at Dow. Ugh. No, thank you. All right, so that would be the end of, I would not hold the position. If I had a position on, I would close it and be content with, okay, it's not doing what I wanted to see it do. Time filter parameter kicked in. It didn't deliver where I wanted to see it deliver, at least the minimum. So I would cut bait. So whenever you hear me refer to cut bait, either I'm in a position, I'm closing it, or I'm no longer interested in pursuing anything for that session. And I would just move to sidelines and be flat and do nothing and not worry about, even if it does whatever it's going to do, I'm not going to go back and look at the chart and say, oh, I wish I would have. Because experience will teach you, if you exist in the longevity is offered to you by doing the right things and avoiding the wrong things. If you stay in this business long enough, you're going to see that there are more times that you're going to wish you would have gotten out versus holding on to it when it's problematic and suggesting otherwise crummy conditions. It's better simply to just move to the sidelines. Because if anybody's looking at this and saying, oh yeah, that's one of those XYZ patterns that always works out, you're talking out the other end. Okay, that's nonsense. So here we have one more piercing of the daily low. And again, I really would have liked to see that 41.0650 level get tagged. We have a breaker now. Old fair value gap, right? And take us right into that. Right there. It's the low on NASDAQ. It made a lower low too. I was looking at the lows from here, seeing if it had failed to make a low. Hold on. I've plotted the NASDAQ comparatively, and I'm looking at the lows plotted on NASDAQ, and I'm comparing respectively the ES lows versus that of the NASDAQ. And 4106 should be hit. And for some of you that just got here, the 4106 level is this over here on a 5-minute chart. That wick right here, and I think we just hit it, didn't we? Yeah, 4106.50. Hit it as consequent encroachment on that wick, and we'll see, does it want to offer any return back up into the gap that has formed. Again, this is, let me make another notation. Opening to Friday's close. That blue shaded area, that's the range. We had it trade up into that, inside this range, this gap. Tried several times to do it. It's moved lower. We've hit consequent encroachment at 4106.50. And I believe that the better price action will be in the afternoon session. The opportunity still lies with, if the market can find a low, set up something as a run into the afternoon up here. I favor that. Based on all I'm seeing right now, that's what I favor. Anything can happen between now and over the lunch hour, but I would like to see that as a potential framework for like the 1:30 to 4 o'clock session. So we got up essentially about halfway through that gap. This is that blue shaded area represented by yesterday's day session close and 9:30 opening today. It's very hard for me to have this on my chart, and I hopefully am not making it harder for you, but this is a lot of lipstick on the chart for me. But I just want you to see the representation of that gap from yesterday's trading to this morning's opening. That range is important, and we see it trade up about half of it here. And I'm going to take this other stuff off because it's no longer seeing it. So just be mindful of that range here. Have those levels on your chart. Yeah, that's going to be it for me this morning. So, not a terribly exciting one, obviously, but you got to see some elements of price action that we like to see deliver, and then also learning when I sit still, why I sit still, what constitutes a reason for me not to want to do it. And unfortunately, when you're new, you can't appreciate that type of lesson because it feels like you should be pushing a button. You should be showing me the market's going to move, a big move. And if the market's not going to move, it doesn't matter how many things I talk about liking about it, it won't make price go up or down.